let's take this discussion forward with Dhiraj Agarwal, MD at Ambit Investment Managers. Dhiraj, great to have you with us. And, this is a good morning to have you on as well, because there's so many moving parts, right? Just when we were heaving a sigh of relief, last week was a good week, we stopped falling. Now we have this fresh salvo from the US. And, this is where it's interesting and slightly confusing. We were sort of complaining about US exceptionalism all of these months, and that was the problem, right? The home trade became too good. Now the home trade is faltering. But will it necessarily mean good things for India?
I know there's we want to be hopeful, but I think I maintain the same stance which I have on the channel last couple of times, that I think 25 is going to be a tough year, perhaps 26 also. And it's got nothing to do with the US. US up and down will impact us mostly at the open trade. I mean, last few times US has fallen 1.5%, 2%. We have seen a gap down open of 0.5% to 0.75%, and the closing has been very, very different. So I won't worry too much about whether US is going up or down, but I worry about the fact that earnings growth in our market has slowed down. I don't see any meaningful signs of a pickup going forward. I'm expecting, I think FY26 earnings growth consensus numbers of 12% or 13% for Nifty will disappoint. It will be perhaps below 10. A lot of damage has already been done, so perhaps not too much of incremental damage from here or too much of incremental deep damage from here, but a very dispersed stock price movements, very polarized stock price movements is around the corner. Where stock picking and making money is not easy. So I continue to hold that prognosis for the time being. And if US actually goes into a recession, as some people are fearing, it's usually not good news for India.
Dhiraj, you rephrased yourself very quickly. Incremental damage, yes, but not incremental deep damage. So you're worried about earnings slowdown and the possibility that even FY26 could be a high single digit or a single digit kind of an earnings picture. Are you worried about domestic inflow slowing down? There was data which came out yesterday how demat accounts in the month of February have hit a 21-month low. Zerodha has flagged off how volumes after the F&O regulations are down, 15-20%. Tomorrow's Amphi data will be the litmus test. But what is the anecdotal evidence that so far it's been the DII, the retail investors, who've held for, they provided that support. But is there some faltering, flagging off of weakening momentum?
It's possible. I mean, you talk about what is historical data, right? What does the historical data say? That's the best benchmark we can use because it's impossible to predict flows. And if you look at, in fact, our strategy team at Ambit Research, Bharat and team have done this job, have presented a very interesting chart in the previous note, that whenever 12-month returns from the market turn negative, DI flows tend to weaken a little bit. And we are almost there. I think 12-month return is just 1 or 2%. In another month or two, the 12-month return will start looking like a decline or a cut. And that usually impacts the DI flows. Now, I'm not a bear on DI flows. I think structurally, Indian households are still underinvested in equities, and it's a very, very structural, multi-year, multi-decade move. But can the roughly 50,000 crores a month kind of a run rate that we are seeing at this point of time, can it drop down by 20, 25, 30% for a few months? You can't rule that out. I mean, that risk is always there.
Got that. You said it can't be good news in any fashion if the US markets enter into a period of slowdown or a recession or things, reach, I mean, it gets bad over there. So what happens? Suppose, are you expecting a US recession? If the froth in the US comes off, how do you expect India to perform in such a scenario?
So, I mean, whether the US goes into a recession or not, at this point in time, the jury is still out. I mean, frankly, I am not in the recession camp. I'm more in a slowdown camp, slowdown and consolidation camp. I'm not in a recession camp. So a slowdown is okay for India. It's neither here nor there. I think we can trudge along if the US economy slows down. But last 30, 35 years that I've been watching the markets, all US recessions have hurt India as well. But I don't think there will be a recession. I think more likely a slowdown. From an Indian standpoint, I mean, there are two things to watch. One is, as I already mentioned, earnings growth slowdown. Second, more important than US at this point of time is China and Europe. just remember a year ago or 6 months ago, people came on the channel and said, where else will investors go? Europe is looking like a museum. China is looking like a graveyard. India is the only growth story in town. Now suddenly people have options. So Europe is no longer looking like a museum. The new German chancellor is promising to break the fisc and go in for a full-blown reflation. Other European countries are likely to follow. China is at the margin, stabilize their property market. Their tech aid is growing well and challenging the Magnificent Seven in the US, and looking like a investment destination worth considering, at least. I mean, if not very attractive, jury is out again, but worth considering. And suddenly India has alternatives, and there are other alternatives in the world as compared to India. So these headwinds are likely to continue for some more time. And we will perhaps be a choppy, volatile market through 25 and most of 26.
Hi, Dhiraj. You're sounding very, very cautious this morning, but there's clearly some part of the market that you'll be positive on, right? It's going to be a difficult year. We get that. I think the good news from an India investor perspective is that we have underperformed. So part of the bad news is in the price. You know, last year was very, very slow on the capex expenditure front, which will only get better in FY26. And the hope is, you know, that earnings will improve. And ultimately, earnings is the most important driver for the markets. There's still a couple of pockets as well which are overvalued. But you would be positive on a couple of themes, right? If you could help us out with that.
So actually, I believe this will be a themeless market, right? So whenever markets go into polarization phase, and polarization simply means that a smaller percentage of stocks will do well and a larger percentage will perhaps struggle or underperform. Whenever we go into a polarization phase, one of the two things happen. Either there are one or two sectors which shine. So like in 2018 to 20 polarization phase, FMCG and a few private banks just outshone everybody else. But if you remember the 2011 to 13 polarization phase, it was very, very stock specific. So I'm actually of the view that we will see a 11 to 13 kind of a phase, where in every sector you'll find winners and losers. So the dispersion within a sector is likely to be very, very high. I mean, if we just look at the last 5 or 6 months as an example, when IT stocks in general have been under pressure, Coforge has delivered 8 to 10% positive returns. And similarly, in many other sectors, you'll find the top performers are either flat or marginally positive, whereas the bottom performers are down 30%. And that's what is more likely to happen, more than the themes. So how do you pick those? One is earnings growth, but more important, predictability of earnings. But the factor which I think will be most important in the market in 25 and 26 will be valuations. So even if earnings growth are coming through, but if the valuations are very steep, one needs to be careful.
Well, those valuations, Dhiraj, just to complete that point, and then I actually want to ask you about something else which is bothering the market today. But just to complete that point in valuation, 15% down at headline index level, 22% down in small caps, mid caps down 20%. Haven't those valuations now corrected to levels which are palatable? I mean, the Indian market's never been cheap in any case, right? So yeah. You still find them a little overbearing valuations?
I think so. I believe in market cycles. In fact, I call my investment framework sine curve. And the essential factor or essential feature of the sine curve is that if this is a line of best fit, let's say this is a line of fair valuation, since we're discussing valuations. Valuations will always move 2 to 3 sigma above mean and 1 to 2 sigma below mean. We are approaching the mean at this point of time, and that too only in nifty. We're not even at the mean for mid and small. But whenever cycles turn, you're likely to see it fall below the mean by 1 sigma or 2 sigma, at least 1 sigma. So the short answer is we're not there yet.
Not there yet. Okay. Let me talk about the other issue and, kind of humorous on this one. IndusInd Bank. Now, I'm not asking you for a stock call at all, but I'm just asking you for the events as they've unfolded for a large cap stock. I mean, we're talking about a big nifty stock here. And the way the market's reacted. Anyway, the market doesn't have any appetite left for, uncertainty, confusion, or nasty surprises. But what do you think is happening here or has happened here with the management extension being shorter than what was anticipated and now this whole derivative issue? how are you looking at the ongoing developments? I don't know if your team covers the stock, I mean, at a research level at all, but this is a bigger question beyond buy or sell.
No, I have no specific comments on IndusInd Bank, but I think you rightly captured it by saying markets at this point of time has no appetite for negative news at all. So it's just the reverse of what was happening till 6 months prior. Negative news would result in a 1 to 2% cut. Positive news would result in a 5 to 15% upward move. And now it's become the opposite. Positive news results in 1 to 2% upward move. I mean, look at BL, for example. You mentioned on the commentary just before I joined that they received another order yesterday. Stock is up 0.5%. But look at IndusInd Bank is down 15. So that's purely what the sentiment of the market at this point of time. In fact, I have a very interesting theory that if you actually pick up a newspaper on a daily basis and with a very unbiased form, divide all the news in positives and negatives, for most days of the year, it's 50-50. But when the sentiment is running positive, the positive news is on the page 1, the negative is on page 10. When the sentiment is running negative, negative news is on page 1 and the positive is on page 10. And that's what drives the market.
You know, it's really telling a story today in IndusInd Bank. This is not about the actual numerical impact that's going to play out in earnings. It's a much bigger issue than that. The freeze opened 10%. The moment it opened, next 15%. That's where IndusInd Bank is today. And by the way, on that analyst call, just to sort of jog our viewers' memory, let's pull up IndusInd Bank if we can. 10% has gone to 15% straight away, drop of a hat. Can we get the stock up on the screen? There we go. That's what we're talking about. That's the next freeze now. It's obviously an F&O stock. So that flex happens and then it opens and then again 15%. Yesterday, when the analysts asked the management that the fact that Mr. Katpalia got a 1-year extension and not a 3-year extension, does this derivative issue have anything to do with it? He said, and I quote, that this would have had a bearing as that is the RBI, they were aware of the issue. But I don't know what the rationale is to give me a 1-year extension, but I think they're not comfortable with my leadership skills of running the bank. So it was from the horse's mouth. Mark is just very, very nervous. Anyway, all right, we live in choppy waters and slightly uncertain times. Thank you very much, Dhiraj, for joining in. I really appreciate you being with us on the show this morning. So that's a call from our market master.